Thank you for joining Money Simplified, your guide to money and mutual funds, presented by Franklin Templeton Mutual Fund. We appreciate your participation. At PersonalFN, we are committed to helping investors achieve their financial goals and objectives. Our core proposition is built around unbiased research and financial planning. We wish to thank Franklin Templeton Mutual Fund for partnering with us in this investor education and awareness initiative. Welcome to the 9th session of Money Simplified, your guide to money and mutual funds. We are glad to have you with us for the 9th session on making productive investments. Alright, so now let's get started. We strive hard all our life to make money so that we can fulfill our dreams and that of our family. And in order to fulfill these dreams, we often invest the money we save. While that's a good habit and one should continue with it, the question is, are you making productive investments? You see, investments need to be made prudently so as to yield fruitful returns for you, or else your dreams could be far-fetched and not turn into reality. While in one of our earlier sessions we introduced you to various asset classes, equity, debt and gold, in this session we'll take you through how to make productive investments. Let's first quickly brush up through some of the important points we have learned in our earlier learning sessions. What is savings? In simple terms, savings means the money left with you after paying for all expenses and liabilities. Therefore, your unspent income results in your savings. To put it simply, savings is equal to income minus all expenses, including obligations towards borrowed money. But the question is, can savings alone be sufficient to fulfill your dreams? The answer is a very simple no. If savings can be sufficient enough to fulfill your dreams, then there would have been no need to invest. Everyone would have kept the savings in their lockers. But the hard truth is that savings will lose its value if you don't invest, and more importantly, if you do not invest wisely. So now let's have a look at what is investing. Investing means productively utilizing your savings with an expectation of earning return over and above the rate of inflation. Investing is a process of making your savings work for you instead of simply stacking it in your vault or bank locker. Now, we all know that you need to invest your savings, but the question arises, where? Well, here are some of the investment avenues where you can invest your savings. Some well-known investment avenues, asset class-wise. Equity. It simply entitles you to become one of the shareholders of the company. So you have a share in both the company's profit and losses. Equity investing offers you an opportunity to earn income in the form of dividend distributed by the company or in the form of long-term capital appreciation. But do not forget, equity investing carries high risk as well. Debt. The way you take a loan from a bank and pay interest on it, the same way the bank or any other financial institution borrows money from you and pays you interest. So the money you lend someone for earning an interest income is your investment in debt. Debt investing is safer than equities, but it does carry some element of risk. Gold. It is a precious metal and used not only to make gold ornaments but also to preserve the value of your money, as it is considered a hedge against inflation. The value of your investment in gold may change based on the prevailing market value of gold, but it does not offer you any regular flow of income. Real estate. Today, when we talk about real estate, we not only talk about a house to live in or a primary home, but also approach it as an investment which can provide us appreciation or rental yields. You see, knowing the asset class is as important as knowing which asset class suits your requirement the best. This is because all asset classes have their share of pros and cons, and hence it becomes imperative to know each of them on various traits before investing your hard-earned money. Key points to consider before investing in equity, debt, gold and real estate. The table here talks about the various parameters for each asset class we just talked about. You see, while equity offers you an opportunity to earn high returns, it comes with high risk. It offers you high liquidity and favorable tax status as well. Thus, if you have high risk appetite with long-term time horizon, then this asset class may be suitable for you. While if you are conservative, then you might feel like investing only in debt as it has a low risk status, but do not ignore the other aspects of investing in debt like taxation, liquidity, etc. The interest income is taxable. Moreover, with low returns clubbed by the debt instruments, you may not be able to beat the inflation rate, thereby eroding the purchasing power of your money. Gold, on the other hand, has the ability to offer capital appreciation, but at times it may be risky. Real estate should be considered primarily for your own dwelling and then for investment. Though it involves high cost and low liquidity, it offers you an opportunity to earn a second income from the rent. So as we said earlier, you should make your investments prudently. If you are unable to beat the inflation rate, then you may end up eroding the purchasing power of your money. Now, you may be wondering how you will lose the value of your money. So to understand it better, let's take an example. Say your desire is to own the latest model of a car, which costs Rs 5 lakh today, but you decide to wait for a year and then purchase it. Mind you, if inflation grows at the rate of 10%, the cost of the car you dreamt of owning may move up to Rs 5.5 lakh. So to fulfill your desire of owning this car, you need to have Rs 5.5 lakh after 1 year. Say you have a savings of Rs 5 lakh. Now since you are planning to buy your favorite car next year, you choose to invest your savings of Rs 5 lakh in a bank fixed deposit, earning an interest at the rate of 8% per annum. But at maturity, a year later, your money in fixed deposit will have grown to just Rs 5.4 lakh, while the cost of your favorite car will be Rs 5.5 lakh in that year. So you may end up with a deficit of Rs 10,000, and not to forget, after paying for the applicable taxes on your interest income, the money in your hand will reduce further. It means the car which you could have bought today may be worth more than the amount you have paid after 1 year. In simple words, if you do not make productive investments, the value of your money, or we can say the purchasing power of your money, will decrease with time. Now let us move a little further and understand how to achieve long-term financial goals. First, you must focus on asset allocation. Asset allocation is a very important strategy when it comes to well thought out investing. Investing with a prudent asset allocation will help you appropriately plan your finances and make sure that you earn desired result after investing a certain percentage of your money in each asset class. Then next thing is diversification. By diversifying your investments, you will choose to invest not only in one type of asset class, but different asset classes and even different types of instruments within a particular asset class. Diversification will effectively help you to reduce the risk on your overall investment portfolio. Power of compounding. For your money to multiply manifold, you need to invest for longer periods. The higher the returns and longer the time horizon, the higher will be the compounded growth of your investment. To understand productive investments better, let us see the historical growth of two popular asset classes, equity and gold. Let us see how equity and gold have performed over a period of 15 years to have an idea of which asset class performs best in the long run. The graph here shows that if you had invested Rs 10,000 each in equity and gold on 30th October 1998, then the value of your investments in gold and equity would have been Rs 66,078 and Rs 97,590 respectively as on 31st October 2013. It means that after a period of 15 years, your returns in gold would have grown at the compounded annual growth rate of around 13%, while your investment in equity would have grown at the compounded annual growth rate of around 16%. So your investment in equity would have outperformed gold by around 3% per annum. Not all asset classes have the potential to deliver inflation-beating returns in the long run. So in order to make productive investments, you need to choose your asset class wisely, or else you may not be able to even beat the rate of inflation and lose the purchasing power of your hard-earned money, thus missing out on some of the important financial goals. So what do we understand? Equity is one of the best asset class in the long run. Even though you might see some ups and downs in equity in the short run, over the long run, it tends to outperform all other asset classes. You can earn income via dividends as well as capital appreciation. In the long run, equity helps you earn a return better than the inflation rate, which means your money should actually grow at a better pace than depreciate. Debt. It's a preferred asset class in the short run. Debt might not be able to give you high returns and may not have the potential to beat the rate of inflation, but it may make sure that your principal amount is protected against market volatility on the condition that you hold it till maturity. It offers you regular flow of income but at lower rates. So if you are looking to park your safe money for a short time period, then debt will be an ideal asset class. Gold, an asset class to preserve the value of money. Gold is considered as a hedge against inflation and will help you preserve the value of your hard-earned money. It may not help you with regular flow of income though. Real estate, an asset class to serve your basic need first. If you plan to buy a self-occupied house, then any time is a good time, as purchasing a home is more of an emotional need rather than an investment. You should not consider real estate as a preferred investment asset class unless it fulfills your basic need of shelter. It is best to ignore your self-occupied house as your investment. The other property that you hold may however be considered for regular flow of rental incomes or capital gains. Finally, before we wrap up today's learning session, here are some important points you must keep in mind to make productive use of your investments. Just investing your savings is not enough. You should invest wisely. As inflation will reduce the purchasing power of money, you should be making productive investments which can counter inflation better and create wealth for you to meet your long-term financial goals. Know the pros and cons of the asset class before investing. Merely investing in an ad hoc manner may not be good for your long-term financial well-being. Less risky assets may not be able to beat the inflation rate, so to earn positive real rate of return, asset allocation and diversification is necessary. Equity has a potential to generate high returns in the long term. Please note that even though equity will show you some volatility in the short term, in the long term it may counter the inflation rate and potentially give you better positive real rate of return. Debt is suitable in the short term. Invest in a safe debt instrument if you're investing for the short term and safety of principal is your main priority. Do not forget, not all debt investments are safe. Gold is considered a hedge against inflation. It will preserve the value of your hard-earned money but may not offer you any flow of income. Real estate should fulfill your basic needs first. Consider real estate for investment only after having one to meet your basic need like shelter. So to end our today's learning session, we now invite you to test your learning by taking up this simple quiz and win exciting prizes. Thank you for participating. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.